Cash flow is the core secret to corporate survival and personal financial stability. Drawing on real-world cases from 2025 to 2026, this article deconstructs 3 types of cash flow logic and combination models, dissects the key factors in corporate rise and fall, extends to building household financial resilience, and reveals the sustainable value of positive cash flow. In January 2026, 2 seemingly unrelated corporate news stories captured market attention. On one hand, South China City Holdings was racing against time in the critical phase of liquidation restructuring, with its 41.14 million Hong Kong dollars cash reserves facing 60.9 billion Hong Kong dollars in massive liabilities, its fate hinging on the deadline at the end of March. Meanwhile, a textile enterprise in Dengzhou, Henan, successfully restructured and revitalized itself through a bankruptcy integration mechanism despite facing cash depletion and over 4 million yuan in debt. Concurrently, 78% of steel-belted tire distributors grappled with dual pressures of rising inventory and cash flow constraints, struggling to maintain their capital chains during the pre-spring festival off-season. Behind the fortunes of these enterprises lies a common core question: how does cash flow, the lifeline of any business, determine survival amid uncertainty? When reported profits diverge from actual cash movements, and when expansion ambitions outpace cash reserves, how can companies break free from this predicament? From the economic crises of a century ago to today's market dynamics, the fundamental logic of cash flow remains unchanged, yet companies continue to stumble along this path. The survival code lies hidden within the rise and fall of countless real-world cases. Trace back to the 1929 Great Depression in the United States, when that global financial storm first revealed the lethal power of cash flow to the world. At the time, a U.S. tractor manufacturer presented seemingly impressive financials, selling 100 tractors in 1928 with $10,000 in book profits. Under the accounting practices of the era, this appeared to be a profitable enterprise. Yet what few knew was that most sales were conducted on credit terms. Farmers promised payment after the following autumn harvest, leaving the factory's accounts devoid of actual cash inflows. The seeds of disaster were thus sown. In 1929, a plunge in agricultural prices triggered a chain reaction, bankrupting farmers and turning the credit sales into irrecoverable bad debts. When the factory needed to pay workers' wages and procure raw materials, its empty accounts plunged it into an instant crisis. Ultimately, this profitable enterprise failed to weather the storm, forced into liquidation by the rupture of its capital chain. Similar scenarios played out repeatedly during that era. Historical records indicate that approximately 130,000 U.S. businesses collapsed due to cash flow depletion during the Great Depression. Even those showing paper profits proved powerless against the fatal blow of liquidity failure. This devastating crisis utterly upended the business world's understanding of profitability. Prior to this, profit had been the sole core metric for measuring corporate value. Businesses only needed to calculate the difference between sales and costs to determine operational success. The Great Depression proved through countless bankruptcies that profit is merely a virtual number on the books, while cash flow is the fundamental lifeblood of a company's survival. Just as the human body cannot function without blood, once a company loses its continuous inflow of cash, even the most dazzling profit statements become nothing but a mirage. Post-crisis, Wall Street analysts began integrating cash flow into their core corporate evaluations, moving beyond blind faith in paper profits. In 1987, the U.S. Financial Accounting Standards Board (FASB) issued Statement Number 95, mandating public companies to disclose cash flow statements, establishing them as one of the 3 core financial reports, alongside income statements and balance sheets. This standard marked cash flow's formal emergence from the shadows, establishing it as a critical tool for assessing a company's true operational health. Notably, while the Governmental Accounting Standards Board (GSB) later issued a similarly named Statement No. 95 still effective in 2025, its core purpose is to defer certain authoritative guidance effective dates in response to the COVID-19 pandemic. This has no connection to corporate cash flow statement disclosure requirements, and the two should not be confused. For the general public, the best way to understand cash flow is to liken it to a household bathtub. Turning on the faucet represents cash inflows. Removing the plug to let water out represents cash outflows. And the water level in the tub represents the actual cash balance held by the enterprise. To sustain operations, a company must ensure the water level in the bathtub remains above the warning line. This is achieved either by increasing inflow through core business activities or financing, or by reducing outflow through cost control and optimizing turnover. Within professional financial systems, this bathtub model is refined into three distinct cash flow categories, functioning like three horses pulling a carriage to collectively determine a company's development trajectory. The first pillar is cash flow from operating activities, reflecting the core business's blood-building capacity and serving as the most critical metric among the three cash flow types. Simply put, it represents the net cash generated from a company's primary operations, the most stable water source in the bathtub. For a restaurant, this equals sales revenue minus daily expenses like ingredient procurement, staff salaries, and venue rentals. For a manufacturer, it's the net amount after subtracting costs such as raw material purchases, production processing, and logistics from product sales receipts. Healthy enterprises invariably maintain stable, positive operating cash flow. CIMC Group's 2025 operational data exemplifies this principle. By the end of the first 3 quarters, the company held cash and cash equivalents totaling RMB 23.86 billion, with net cash flow from operating activities reaching RMB 9.827 billion, a significant year-on-year increase. This achievement stems from the successful fulfillment of core business orders, the implementation of cost reduction and efficiency enhancement measures, and accelerated recovery of accounts receivable. A robust operating cash flow not only safeguards daily operations but also lays a solid foundation for future shareholder returns and strategic investments. Conversely, if a company reports substantial profits on paper yet maintains persistently negative operating cash flow, it signals a profit trap that warrants vigilance. Such a scenario often indicates that profits derive primarily from accounts receivable rather than actual cash receipts, or that significant capital is tied up in excess inventory. By the end of 2025, distributors in the all-steel tire industry found themselves in precisely this predicament. Despite upstream tire manufacturers issuing price increase notices to restore margins amid soaring raw material costs, sluggish end market demand stifled distributors' sales. According to research data from Chuang Information, 78% of surveyed distributors faced rising inventory pressures in December 2025, while only 5% managed to reduce their stock levels. The inventory backlog directly tied up substantial capital, while year-end pressure to collect receivables further exacerbated cash flow constraints. Many distributors found themselves in the awkward position of profits on paper but no cash in hand. The second driver is cash flow from investing activities, which records a company's strategic investments for future growth akin to renovating a bathtub to expand capacity and enhance competitiveness. Purchasing fixed assets, building new factories, conducting R&D, or making external investments all generate cash outflows from investing activities. Conversely, selling assets or transferring equity brings in cash inflows. Unlike operating cash flow, the positive or negative nature of investing cash flow isn't an absolute indicator of a company's health. It must be evaluated holistically alongside the company's stage of development. For growth stage companies, negative investment cash flow is the norm, reflecting sustained future-oriented investments. Tesla's 2025 financial data exemplifies this. Its net investment cash flow from January to September was $8.95 billion, primarily allocated to constructing global gigafactories and advancing battery and autonomous driving technologies. Such large-scale investments may appear as capital outflows, but they are actually building long-term competitive advantages. Encouragingly, Tesla's investments are gradually yielding results. In Q3 2025, its net cash flow from operating activities reached $6.238 billion, while free cash flow soared to $3.99 billion, setting dual records that validate the rationality of its investment strategy. Conversely, persistently positive cash flow from investing activities in mature companies may signal danger. This typically indicates the company has exhausted new growth avenues, unable to generate value through investment. Instead, it relies on liquidating accumulated assets to sustain operations, trapped in a leaving off past achievements decline. Against the backdrop of industry cyclical adjustments and macroeconomic fluctuations, some traditional manufacturers face this predicament. Lacking a clear path for core technology upgrades, they resort to selling factories, equipment, and other assets to raise capital, ultimately losing market competitiveness. The third component is cash flow from financing activities, reflecting capital transactions between the company and its capital providers akin to external pipelines. Replenishing a bathtub. Financing actions like bank loans, bond issuances, or stock offerings generate cash inflows, while loan repayments, bond redemptions, shareholder dividends, or share buybacks result in cash outflows. The positive or negative nature of this metric must also be interpreted within the context of a company's life cycle, as it reflects both its financial strength and the confidence capital markets place in it. Startups and growth stage companies, lacking sufficient self-sustaining cash flow, often rely on external financing to support development, resulting in predominantly positive cash flows from financing activities. Conversely, for mature, stable companies with ample cash reserves, negative cash flows from financing activities actually signify strength. Apple Inc.'s 2025 financial data exemplifies this. Its net cash flow from operating activities reached $111.482 billion, indicating exceptional capital abundance. Building on this, Apple rewarded shareholders through stock buybacks and cash dividends, resulting in a net cash outflow from financing activities of $120.686 billion. This negative cash flow does not indicate financial strain but rather demonstrates robust corporate health. The company can cover investment and shareholder return needs solely with cash generated from its core business without relying on external financing. CIMC Group also exhibits a similar virtuous cycle. In 2025, leveraging its strong operating cash flow, the company intensively rolled out share repurchase plans. In September, it announced a repurchase of shares using 300 to 500 million yuan of its own funds. In May, it announced a 500 million Hong Kong dollars allocation for the first batch of 8 share repurchases, followed by an additional 300 million Hong Kong dollars for second batch in December. As of December 18th, the first batch had completed repurchases totaling 451 million Hong Kong dollars, accumulating 60.4912 million H shares. This virtuous cycle of operational improvement gives abundant cash flow, gives enhanced shareholder returns, not only bolsters investor confidence but also provides a solid foundation for the company's subsequent industrial upgrades and new business initiatives. Analyzing individual cash flow categories in isolation yields limited insight. Only by examining their combined patterns can one truly discern a company's operational health. In business practice, 4 typical cash flow combinations correspond to distinct corporate survival states and foretell varying development prospects. The most ideal combination is the positive-negative. Negative pattern, positive cash flow from operating activities, negative cash flow from investing activities, and negative cash flow from financing activities. This pattern is termed the cash cow model, exemplified perfectly by Apple's 2025 performance. Net cash flow from operating activities of $111.482 billion positive, net cash flow from investing activities of $15.195 billion negative, and net cash flow from financing activities of $120.686 billion negative. The core logic is this. The company generates stable cash flow from its core business, allocates part of that cash to future investments, and uses the remaining cash to repay debt or reward shareholders. Such companies exhibit healthy financials, strong risk resilience, and sustainable growth potential. The second category is the positive-negative positive pattern corresponding to growth stage star companies. These firms exhibit positive cash flow from operating activities, indicating their core business has achieved self-sustaining profitability. Negative cash flow from investing activities signifies they are in an expansion phase requiring substantial capital for capacity upgrades, R&D, or market expansion. And positive cash flow from financing activities means cash generated by core operations is insufficient to cover investment needs, necessitating external financing to supplement funds. Tesla repeatedly exhibited this pattern during its expansion phase. From January to September 2025, its net cash flow from operating activities was $10.934 billion positive. Net cash flow from investing activities was $8.950 billion negative, and net cash flow from financing activities was $429 million positive. Such companies possess significant growth potential but also carry inherent risks, with their future prospects hinging on whether investment projects can successfully translate into tangible returns. Tesla's third quarter 2025 free cash flow of $4 billion unequivocally validates the effectiveness of its investments. The third category follows a negative positive pattern, representing a classic financing-dependent expansion model that warrants high vigilance. Companies in this category exhibit negative cash flow from operating activities, indicating persistent losses in their core business and an inability to generate positive cash inflows. Negative cash flow from investing activities signifies ongoing investment expansion. Meanwhile, positive cash flow from financing activities reveals that the company relies entirely on external financing for capital, effectively sustaining operations through external funds. Many internet startups initially operate in this state, hoping to capture market share through upfront investments and later cover costs with future profits. However, this model carries extreme risk. Failure to secure subsequent funding immediately severs cash flow, leading to bankruptcy. In the 2025 market environment, some capital-dependent cross-border e-commerce companies faced cash flow crises due to funding obstacles. The fourth category is the negative-positive pattern, a high-risk asset liquidation for debt repayment model. Negative cash flow from operating activities indicates the core business has lost profitability. Positive cash flow from investing activities signifies the company has begun selling assets to raise funds. And negative cash flow from financing activities reveals the company must repay debts, with funding pressure reaching its limit. South China City Holdings' current situation aligns closely with this pattern. By the end of 2024, the company recorded a net loss attributable to the parent company of 8.986 billion Hong Kong dollars, with 15.742 billion Hong Kong dollars in borrowings already in default. Its cash and cash equivalents stood at a mere 41.14 million Hong Kong dollars, far insufficient to cover its 18.241 billion Hong Kong dollars in current liabilities. To survive, South China City initiated liquidation restructuring, attempting to negotiate debt relief for a lifeline. However, the creditor support assessment by the end of March 2026 will determine whether it can prolong its existence. Such enterprises are already in dire straits, often just one step away from bankruptcy liquidation. The above case clearly demonstrates that cash flow's core logic permeates every stage of business operations. Neither large-scale listed companies nor small and medium-sized enterprises can escape its influence. For SMEs in particular, their smaller scale and weaker risk-bearing capacity make the impact of cash flow shortages even more devastating. In March 2025, a survey by China Economic Net revealed that many SMEs face pressures including market contraction, reduced orders, and rising raw material costs. Compounded by prolonged payment cycles and overdue receivables, their cash flow situation continues to deteriorate. In certain engineering projects, the practice of subcontracting through multiple layers further compresses profit margins for SMEs, making their capital chains even more fragile. The national government has long recognized this issue, enacting multiple policies and regulations to safeguard SME payments. A series of supportive measures including reduced financing costs, expanded tax incentives, and enhanced financing guarantees have also been implemented. Yet in practice, SMEs' cash flow challenges remain unresolved. Financial institutions must further optimize services by offering flexible financing products tailored to SMEs' actual needs, eliminating hidden barriers, and continuously lowering overall financing costs. Simultaneously, addressing corporate debt issues and smoothing market credit transmission mechanisms are essential to truly stabilize SMEs' capital chains. It is worth noting that cash flow is not solely a corporate concern. Its core logic equally applies to individuals and households, just as businesses must balance cash inflows and outflows. Individuals and families also need to manage cash flow wisely to build financial resilience and navigate uncertainty. China Financial News previously published Building Household Financial Health Amid Uncertainty, a study of financial diaries among China's low to middle income families. Tracking 197 low to middle income households in Yijin County, Shaanxi, Pingjiang County, Hunan, and Shanghai revealed that income volatility and cash flow deficits are the primary financial challenges these families face. Survey data revealed distinct regional patterns in cash flow volatility. In Yijin County, where households primarily engage in agricultural production, cash outflows exceeded inflows for 7 months annually, with income fluctuations largely driven by seasonal agricultural cycles. In urban or small-town households like those in Shanghai and Pingjiang, cash flow volatility concentrated around key events such as school enrollment and Chinese New Year. For rural households, the loss of a primary laborer can abruptly sever income sources, intensifying financial pressure. While self-employed individuals and flexible workers are more vulnerable to sudden income drops from external shocks. These findings underscore the critical importance of household cash flow management and provide micro-level insights for designing inclusive financial policies. Robert Kiyosaki, a Japanese-American author, offers a core principle for personal cash flow management in his book, Rich Dad, Poor Dad. Assets are things that consistently generate cash inflows, while liabilities are things that consistently cause cash outflows. This definition transcends the conventional notion that assets are high-value items, instead using cash flow direction as the sole criterion, a principle with significant implications for personal finance. Take housing as an example. Traditionally viewed as a core asset, its status is not absolute from a cash flow perspective. If a home is owner-occupied, monthly costs like mortgage, property fees, and maintenance represent ongoing cash outflows, making it a liability. Only when the property is rented out, with rental income covering all holding costs and generating a surplus, thus producing a sustained positive cash inflow, does the house truly become an asset. The nature of automobiles is even clearer. For most people, purchasing a car requires a loan, and daily use incurs expenses like fuel, insurance, maintenance, and parking fees. Additionally, the vehicle itself depreciates continuously and cannot generate cash inflows, making it a classic liability. Based on this logic, distinct cash flow patterns emerge across income groups, determining their financial health. The cash flow pattern of the poor is the simplest. Wages are the sole source of cash inflow, entirely consumed by daily expenses, leaving them living paycheck to paycheck with no savings accumulation. Unable to acquire assets, they perpetually struggle just to survive. The middle class exhibits a more complex cash flow pattern. While earning higher wages, most cash is directed toward purchasing traditionally perceived assets like homes and cars. However, these items are effectively liabilities requiring ongoing financial investment for maintenance. To cover these debt obligations, the middle class must work harder. Trapping them in a rat race cycle of income increase gives debt accumulation gives working harder. Their financial position is fragile. Any disruption to their primary income source could plunge them into crisis. The cash flow model of the wealthy is entirely different. Their cash inflows are diversified, with passive income from assets such as rent, dividends, bond interest, and business profits forming the core beyond salary. The wealthy prioritize investing in assets that generate positive cash flow, using the returns to cover daily expenses. When passive income fully covers all expenditures, financial freedom is achieved. At this point, work is no longer a necessity for survival, but a choice for self-fulfillment. This divergence in cash flow models is precisely the core reason behind the widening wealth gap between different income groups. For low and middle-income households, building a healthy cash flow model and enhancing financial resilience requires tailored measures based on individual circumstances. Financial regulators and institutions should also provide greater support. This includes offering tailored microfinance products and medium to long-term agricultural loans aligned with farmers' seasonal income patterns, lowering barriers to financial products to provide more investment options for low to middle-income groups, and optimizing inclusive insurance products to cover low-frequency, high-loss risks, thereby bridging insurance gaps. Additionally, mutual aid organizations can play a unique role in household financial health by sharing risks through collective support and alleviating cash flow pressures. Returning to the core challenge of business operations. Whether it's a century-old tractor factory, today's Tesla, Apple, or South China City, or the countless small and medium-sized enterprises struggling to survive, cash flow remains the ultimate determinant of their fate. Profits can be adjusted through accounting maneuvers, and asset valuations may fluctuate with market conditions. But cash flow is the objective reflection of an enterprise's actual capital circulation. It never lies. In an increasingly uncertain market environment, businesses must firmly grasp this lifeline of cash flow to survive and thrive. For enterprises, building a healthy cash flow system requires first strengthening the core business's ability to generate cash. This involves optimizing product portfolios, enhancing core competitiveness, and accelerating the recovery of accounts receivable to ensure stable, positive cash flow from operations. Second, rationally plan investment strategies by aligning expansion plans with cash reserves and profitability to avoid capital chain strains from reckless investments. Finally, wisely utilize financing tools while relying on external funding. Prioritize maintaining creditworthiness, diversifying financing channels, and reducing borrowing costs. On January 4, 2025, the successful restructuring of a textile enterprise in Dengzhou, Henan, provided a model for companies facing cash depletion yet possessing core value. The Dengzhou court fully leveraged its enforcement bankruptcy integration mechanism. During the enforcement phase, it proactively identified the enterprise's restructuring potential. Rather than simply liquidating assets, it developed a scientifically sound operational plan through bankruptcy reorganization, ultimately helping the company achieve a new beginning. This case demonstrates that when enterprises face cash flow crises, bankruptcy liquidation is not the only path. By accurately identifying core value, optimizing resource allocation, and negotiating debt restructuring, it remains possible to revitalize assets and restore cash flow vitality. From corporations to individuals, from economic crises of a century past to today's market dynamics, the core logic of cash flow remains unchanged: Sustained, stable positive cash flow is the foundation for survival and growth. For businesses, understanding the three-pronged approach of cash flow reveals the essence of operations. For individuals, clarifying the cash flow attributes of assets and liabilities points the way toward wealth accumulation. In an era of uncertainty, both businesses and individuals must firmly grasp this core principle of cash flow, balancing income and expenditure while strategically planning to weather the storm and achieve sustainable growth. As the 2026 Spring Festival approaches, steel-belted tire distributors continue grappling with high inventory and tight cash flow. Restructuring negotiations for South China City enter their final sprint phase, while countless SMEs and households persistently navigate their respective cash flow trajectories. The narrative of cash flow unfolds relentlessly, with the codes of survival and growth continually validated and refined through practical experience.